All right, good morning. Good morning, everybody. You should be on the new contracts if you're trading the futures. ES and the NASDAQ should be on March. Now, if you look at the volume this morning, they're not quite as high as the December series, but most places have already rolled. For an example, Thinkorswim auto rolls, and it is already showing March as the contract. If you're just looking at them, then you can use the what they call a continuous contract. You don't necessarily have to put in a specific contract. It'll just be what they consider continuous. But if you're trading it, it should be on March. NASDAQ up the most, less than a half. S&P behind that at a quarter, small caps, and the Dow basically flat. China down the most. We're going to get some PMI data this morning, 9:45. So it's one of the weird ones. Not at 8:30, not at 10, 9:45. This week, it's a lot of smaller stuff into FOMC on Wednesday, and then OPEX on Friday. Third Friday of the month, the 20th. You can always count on that. Third Friday of the month. So it's very likely that we go into a hurry up and wait holding pattern into FOMC. But we've got a lot of events happening around the world that could put us in gear, kind of kick us higher or lower. Just the base case argument is that we hold the line. We've got some auctions in the front end today at 11:30. And we've got Bank of Canada in the afternoon. It's close enough to the end of power hour that maybe this one, won't have too much of an impact other than having us kind of sit out. Maybe we'll see some lowered volumes or lowered participation waiting for that. But I don't see the event itself causing too much trouble that close to the end of the day. So I continue to point this out because I keep getting asked about it. If you're trying to build your bias on the day, it's not going to come just from the candles, right? Trying to get a feel for what's the market supposed to do today. You want to read headlines, check the news, see what's been happening around the world and what is on the table for today. At Finance Juice, you don't need an account, but it would help if you get one. It's free. It doesn't cost you anything. Make an account, use the filter, get rid of news that you don't want, like Fox News, MSNBC, and all that trash. Turn that off because it'll remember your settings if you have a free account. They do a pre-market briefing, and then they do a market wrap for 3 markets around the world: Asia, Europe, and the US. So even though the US isn't quite open yet and Europe's not closed, they will give you a Europe market wrap, give you a good idea of what was happening in the overnight hours. And within, say, another 20 minutes or so, they're going to post a pre-market briefing that'll give you an idea of what's on the table for today. It really helps for you to have a consistent product that is free. It doesn't cost you anything. You can get it every day. It can help you build that bias on what we think is supposed to happen today. We're going to see a market maker move most of this week. It's because of the contract change and OPEX. So typically when we see this, we would expect that there's some hedging activity in the front end. But we're going to see this all week, and we just have to pretty much ignore it, right? It's going to be there, but it doesn't have any significance to it. can see that the volumes are really light. I am on the March series because Thinkorswim already rolled. It's a little light. Volumes during contract change are always misleading anyways. There's a lot of contracts that are getting rolled, which look like volume, but it's not initiating new positions, right? So it's just the way it is every time we change contracts. Otherwise, the put wall is really close to yesterday's low. Volatility trigger above that. We're back above the 10-day moving average, and we're getting closer to the upper ADR half. 6150, which is a round number options level. It's going to be tricky to get through that. It's also really close to Friday's regular trading hours open. So a nice little overlap there. That's multiple levels of resistance at that 6150. If we can get through it, we'll focus on getting an inside day breakout from Friday. Then we can challenge the call wall and the ADR full, that yellow line up there is 6175. To the downside, if we break the put wall, we have the 20-day moving average, the lower ADR at around number 6100. There's 6111 cog line just in front of that 20-day moving average. Then the 3-week 0 gamma 6092 cog line, and then we get like an air pocket of risk and things really get ugly. This happens frequently when we get these contract changes, that we're going to see this exaggeration from where we were to where we are. It shows us with this really big gap up. But if you look at the other contract, we're just trying to split the mid, right? Trying to split the difference. The December is trading at 60.70. So, 60.70. It's all the way down here. We're up a little this morning, to be fair, right? We closed down here this morning. We're up here, but we're not all the way up here. That's just a function from a change in contract. So if you're wanting to do technical analysis, like swing trade, that sort of thing, don't use the ES at this point. Swap over to SPY, SPX, use something like that. Got the ADR down to 82. I'll be surprised if we can get it below 0.80. At some point, we're just going to run out of how far we can compress volatility before it starts to turn around. As mentioned, we're closer to the upper ADR than we are the lower one. Base case argument will go up and hit that. On a week where we're expecting to wait on data, I would expect to stay within the ADRs. Even if we break out of the ADR, the base case argument would be that we come back in again. Breakouts fail, we come back in, we hold the line, wait on data. We've seen this movie before, though. These weeks where we've got FOMC on the table, everybody thinks we're going to go sideways, and with lowered volume, we just grind higher or grind lower. Lower is what we've been doing. We kind of zoom out a little bit, look at Wednesday into Thursday, Friday, and then this morning. All of that last week was just a grind down from where we had closed on Friday the previous week. So even though we're waiting on data, we've got FOMC on the table, the market can just continue to grind, but focus on how far we should move on a day-to-day basis. I'd say the ADRs, the red ones at this point, should contain price. If some really good news or some really bad news comes out, sure, it's always possible we could break out and go. Well, we got a really nice overlap this week. All right. It's not showing the weekly this morning with the contract changes. We've only got the daily. Yeah, it's all the way down here. Another awesome function of a contract roll. So for this morning, just focus on the daily. Today's floor pivot lower than yesterday, that's bearish. Price opened below both of those, that's bearish. We've ran up and hit it, broke through it, we're above it. Now that we're above it, we kind of need to keep it. One function that we could turn on is the SNR levels, kind of look at how far apart they are compared to where they have been. We can see today it's a little wider than what we had on Friday, for an example. Take Fridays and overlap it onto today. Today's much wider than yesterday. So we could get to R1 easy enough, or S1. I think trying to get beyond that to the next level would need some sort of catalyst or fuel to get the job done. So we got last week's point of control. We're there. That 61.41, 61.42, that's last week's point of control. If we can get above that, we can start challenging last week's levels. But at this point, hard to see the fuel for that. What's going to be the catalyst to really get it above there? If you're focused on it from higher highs and higher lows, then we've already got the function set where we topped out and we started putting in these lower highs. So kind of got this low structure down here that's already been broken. We got to see what's up with this high right here. If we fall back without getting up here, then it's going to give us that lower high. Otherwise, if we can get through 61.50, then we can challenge that 61.60 and put a new high in here. This is a complex topping pattern. So if you want to, if you want something to focus on for material, that'd be what you want to search for, complex topping patterns. Just like a complex swing high, complex swing low versus your normal topping pattern and normal swing high, normal swing low. Grimes did a really good job in his book on these. $61.11 COG was tested last week and held so far, right? We broke through it a couple of weeks ago, was running above it. Now we've started to come back down, tested it once. Basically, we tested it twice. There's a phrase 1, 2, 3 fail. So let's see if we can test it for the third time and begin the breakdown, or if we're going to challenge that 61.60 this week and begin the next leg back up. But we have to get across this point of control from last week. 10-day, 30-minute volume profile, like we talked about last week, we're not seeing this point of control move unless we can hold the line here at this 60-32 area. So if we can stay here and just build out structure, then we'll bring that point of control down to us. Otherwise, breakout of last week's point of control, begin working our way back up to that 60-60 breakout, 6160, get back into 6170 and put some new volume up there. No VPOC from Friday. We've got some lower ones, but they're going to line up with levels that aren't here anymore. And I've had this conversation before about, why do we even mark these, and would they still be relevant if they were built on old contracts? Well, the idea is unfinished business. We mark out where points of control are, and VPOCs like this, due to the idea that if we revisit an area that had the most volume traded, there's likely people with unfinished business who are willing to trade again. That kind of gets taken off the table when those contracts aren't even around anymore and that they've rolled them into a new position. So once we do get the contract roll, all of the VPOCs that we have been marking, they're going to be off the table for me anyways. I just don't see any reason to carry them forward. They don't have the same value anymore. And with a new contract, it's messing up the weekly expected move. So a couple of ways to do this. You can just get the current right now weekly expected move. That would be for Friday. It's right here, $66.20. But that's not the one we want. We wanted it from Friday after the close or over the weekend before we opened up Sunday night. Because when we opened up Sunday night, it started to move and it's no longer the same value that it was, right? It's the right now expected move, not what it was last week when positions were being built on it. So I would focus, if you're going to look at the expected move, for right now, I would say stay with the SPX unless you manually drew your lines out anyways. So if we're gauging volatility, kind of asking the question, does this week's volatility suggest that it's higher or lower than last week's volatility? Then we can just draw the box on last week, set it on this week, and see what the answer to that is. They're about the same. Now, I didn't put it in to the tick perfect. It's close enough. We're just trying to get a feel for the volatility. And if it's that close, then it's the same thing. We're still above the 10-week, more than 2.5%. So we're good, but we're not overbought, not overextended. We're not pushing too far, too extreme, too fast. And it doesn't owe us any sort of pullback. Distance from the 10-day, we're there. Now, this can act a bit like a magnet and a gravity where we just hover around it, crossing back and forth above it and below it. And it won't necessarily be a support or resistance. We should cut above and below with impunity, just back and forth. It won't really be a function of support or resistance until we can leave that 10 behind, and then we come back and visit it. So at this point, it kind of ties in with the base case argument that we're going to hold the line into FOMC. dancing back and forth around the 10, holding sideways, waiting on data, waiting on FOMC before we make a move. That'll also tie in with a move of significance after FOMC, because the longer we stay sideways, the more energy we build up for the move that's coming. Looking at what was happening over the last 5 days, you can see all the markets are down except for consumer discretionary. That'd be the one in the upper right. Otherwise, everything else is down. Now, Staples, lower left, is only down 0.25%. Financials, a little more than a quarter. And tech, almost flat over a 5-day period, but still all negative except one. So if we're going to see this rising tide scenario, we've certainly had the pullback of sufficient quantity in all of these. I mean, even without zooming in, you can really see that red bleed. Staples, it maybe was weak and slightly choppy, but certainly doesn't have that red bleed that the others have. And then tech trying to get back up and break out from this level back here. So we could be setting up for a dead cat bounce in multiple sectors. Tally these up, you might be looking at 65, 70% of the market. If the 65 to 70% gets a bounce, is it going to take away from consumer discretionary, or is it going to be more like a rising tide where everything finally starts to rise? It'd be something that we got to focus on this week. Of course, we don't have to bounce, right? We can just hold the line, chop at these lows, or fall even lower. But I'd say a lot of them are coming into support or supportive structures. Then there's the issue of strength or health. This purple line is the 200 period moving average. And we've got building materials, energy, healthcare, all under that 200 period moving average. And breaking down into lows or into new lows on the year. That's not strong, good, healthy. Pick your word. So this morning we've got Bitcoin, precious metals, Mag 7, and bonds. That's up in the pre-market. Semiconductors are up, but not enough to meet our qualifications. And things that are down, China and a little bit of energy. Not much. So with the Bitcoin being up, could focus on, say, Riot, Mara, Hut, Hood, Hive, MSTR, Coin. Those will likely give you some flavor. There's a lot of semiconductor names that tie into Bitcoin. So with Bitcoin being up and they're not up yet, that could be a play to see those come around, especially say like some of the big names, NVIDIA could get a little bit of a turnaround in that space. Yeah, we got Square, but we don't have PayPal up 0.5% yet, or AMD. NVIDIA is still in the red, and they're in my crypto list, so they're just not there yet. They're worth keeping an eye on in case they can turn around and join the party. crude, China, nat gas. Solar's negative, but not enough to meet our benchmark. So it'd have to bleed down some more to get anything out of solar. I'd say keep your eye on Bitcoin, see if it can get some assistance from the chip space. And then, of course, we're just stuck watching the clock, looking for news that can break us out of the cycle. I think we're setting up for a pretty boring week. So this is what it looks like when they post their pre-market prep. It's just a tiny little blip. You got to look for it, right? But click on it, it opens up another page and it gives you their insight and things that they have on the docket for the day. It's the same thing every day. They offer you that. Plus, they give you the backdrop of what was happening while you were sleeping with Europe. And if you scroll back far enough, because this is just the Europe wrap, scroll back even farther, you'll get the Asia wrap from what happened in Asia last night. And then it closed. Then they had a pre-market Europe. And now we're getting the aftermarket Europe, pre-market US. After we close today, there'll be another one just like this with a US wrap. If you're trying to get better at building your bias, that's a really good way to go. All right, what I have marked here is yesterday's RTH from the high to the low intraday. I didn't catch the Globex, but it wouldn't change much at this point if we did use all of it. So we're above the half, kind of need to keep it. If we can keep it, we could challenge yesterday's high, that 60.60. But I think that 61.50 is going to be the issue, right? 61.60 for an inside day breakout. Otherwise, we'd have to come all the way down, break 61.15. There's a cog line at 61.11. We'd have to get underneath that, which is like the 111 anyways. Funny how that ties in. So 111 at 61.11. So what I got for you guys, be careful, be safe, watch the clock. I'll see y'all tomorrow.